Well, hi everyone, Sean Humphreys here. Welcome to Take Charge of Change. What we've done with this video is we've put together just an illustration of the kind of financial planning software that's out there that financial advisors use. So we've done this because we've been putting together a series of blog posts specifically dealing with one of life's biggest transitions, and that's retirement. So of course at Take Charge of Change, one of our focuses is to curate content to help people navigate the major life changes that we go through and do it in a resilient fashion. So in this particular video, we're going to be talking about a piece of a blog that talked about some of the preparatory steps for developing a retirement strategy and ongoing financial planning. So in that post, we talked about the fact that if you go online, there's a lot of simple calculators for retirement income planning. And I think that's a good place to start. But the reality is, retirement planning is increasingly becoming much more complex. When you think about it, we've got the integration of tax-free savings accounts, RSP accounts that ultimately become RIF accounts. We've got, in some cases, locked-in retirement accounts that get converted to LIF accounts, and sometimes prescribed annuities, and then sometimes a regular annuity, and then you might have a defined benefit pension plan or a defined contribution pension plan, and finally you might have open or non-registered capital, and for some of you, you might be business owners, you've got retained earnings within the corporation that you might be using to supplement retirement income as well. It can be very complex, a lot of moving targets. So what you'll find is most of the simple calculators online just do not do a good job. So most financial coaches and retirement coaches will use very powerful financial modeling software to begin simulating what retirement might look like from a financial standpoint. And that's what I want to show you very quickly. I'm not going to go through this in a lot of detail, just to give you a very quick overview so you understand that when you talk to your financial advisor or your wealth planner, ultimately one of the questions you ask is, do you have access to this kind of modeling software so that you can plan effectively for retirement? So this is called FP Solutions Advanced. It's one of the different kinds of software that's out there. And so we've loaded up, this is Sam and Sally sample, and we're going to go through some of their goals a little bit here in terms of the plan. So let's just take a look at that. So we'll go to the personal information. We go to the personal information. You can see here as we scroll through it, let's see if I can get this working here. So date of birth, you can see the date of birth there, anticipated retirement age 60 and 59. And so they're going to be going through a bit of a retirement transition. When we went and asked them about what their lifestyle goals would be for retirement, what they said to us is that they wanted to have an after-tax income of, and by the way, the numbers are not important in the context of this plan, but they wanted to have $85,000 a year in after-tax income when they retired. Now, the other thing we did is we talked about some assumptions around inflation and returns. So for this particular analysis, we're using a 2.5% inflation rate, and we used a 4% return on the portfolio. Now, that may not be the return that you're aspiring to. In this example, 4% is relatively conservative. But I think in all the assumptions, particularly when you forecast out retirement, you want to underpromise and overdeliver. You want to start with a base case scenario that under the worst case circumstances, could we reach our retirement goals? And then you might have another case that you put together that looks at, well, if we initiate certain kinds of strategies, maybe get a little better return, do better tax planning, what could that mean as a difference? So those are the key assumptions in this particular analysis. Now at 2.5% inflation, what's interesting is I'll go back to the cash flow numbers here. So again, we'll go to lifestyle expenses, and then when you go to those expenses, you go to ledger sheet here. And what you can see from this ledger sheet is, again, there's that $85,000 per year of expenses. At 2.5%, it's now $89,000 for inflation. And then by year 10, at age 68, it's $106,000 of after-tax cash flow. 20 years into retirement, it's now $135,000. So we've gone from $85,000 after tax to $135,000 after tax at 2.5% inflation. So it has obviously a very real impact. Now the other thing we do is we build a net worth statement, and I'll just quickly show you on this financial calculator and forecasting tool. Under detailed projections, we go to projected net worth, and then we'll go to the ledger statement here, or a summary. And now you're seeing what the net worth potentially could look like. So in this particular circumstance, the client had $285,000 in non-registered, their spouse $386 for a total of $671. They had some RSP capital, They had some defined contribution pension capital and some defined benefit capital. So again, the numbers are not important. What I want to illustrate is just how we begin building the financial statements to begin modeling for retirement. At the heart of this analysis is something we call the optimizer tool. And this optimizer tool allows us to get into, when is retirement going to happen? When are we going to begin drawing down on financial capital, as an example, to supplement other pensions? Pensions might be Canada Pension Plan, Old Age Security, maybe defined benefit pension plan from work. And we begin talking off various assumptions around where we're going to take income from, and then if there's any cash flow excess, any surpluses, what we've assumed is we'd reinvest the surplus. We'll spend at a steady rate of $85,000 after tax at 2.5% per year indexed, and if there's any surplus, we'll reinvest that surplus back into the portfolio. Now this optimizer tool is very powerful, and what I want to do is I'm going to go back, I'm going to unoptimize this just to show you what the tool does. So we'll hit Reset Optimization, and then what you see here on this reset, and again, let me just get through this particular box. Hopefully it closes out soon. Okay, here we go. So it's hard to make it out, but this green line that cuts across here, and you can see there's some minor shortfalls between the bars. And these bars here, for the husband and wife or partners, are the after-tax values of their cash flow. So we've got the brown for Sam, we've got the yellow for Sally. And you can see that there's some shortfalls in their early 60s. Then going into their mid-60s, they're running a balanced budget for the most part. They've got enough income to spend at that $85,000 per year. And then in the later years, you can see they're running some shortfalls again. So what we're going to do is we're going to go back into the optimizer, and we're going to pull out every single year from their portfolio assets, RSPs, non-registered, and then eventually down the road tax-free savings accounts. We're going to start pulling capital out. So the program will go through and it does a year-by-year calculation. So based on what comes out of the RSPs, open account, there might be some capital gains triggered. It's going to do a year-by-year T1 for each person in the couple situation and keep running through and building this cash flow model so that they're fully funding all of their income needs over the length of the retirement. So literally simulating what the cash flow will look like based on certain assumptions that we're using for their situation. So let's just let this thing run. It'll eventually finish off for us. Okay, now the optimization is complete, and what you can see here is we go through the years, there's no shortfalls. We're fully funding the $85,000 per year in after-tax income all the way through, and we took this to age 90. Now, I'll just make a comment right now about that. So people go, well, age 90, I'm not going to live to age 90, or my expenses won't keep going up over the years. You can see here we went from $85,000, and by age 90 we're up to $180,000 at 2.5% inflation. Well, here's the reality. So first of all, I would not agree that expenses decline. In fact, there's a lot of reason to believe, and in fact, one of the posts in this retirement series talks about the impact of demographic changes and the aging of the population. Yes, discretionary expenses are going to go down, but non-discretionary expenses are not. And the biggest of the non-discretionary would be healthcare expenses. So don't presume that those expenses are going down. The other thing is, the reality is in a couple situation particularly, there's a very high probability that one of you would live into your 90s if you look at from a probability actuarial standpoint. So using age 90 is not an aggressive kind of assumption. People look at that initially and go, I'm not going to live that long. I wouldn't assume that, and I think age 90 is probably the minimum that we want to use. Now, again, we want to make sure we're using conservative assumptions because once you retire, it's very difficult to initiate a redo on your retirement. It triggers a lot of things that are somewhat permanent in nature, and so you want to make sure you do really good planning in your homework very precisely before you retire. So what you see is no gaps along this line here, but what you do see is sort of turquoise color. So what is that? Well, some of the money that was coming in was obviously from CPP, OAS, defined benefit pensions, and registered capital, for instance from RSPs and RIFs. But there were years later on where the client was drawing on tax-paid money, non-registered capital, to supplement. But you can see that they fully funded the retirement income needs all the way through. Now, what I'm going to do is I'm going to show you another version of that particular statement, which is a lot more detailed. This is a great statement to go through. It's a detailed audit trail. clients like it because they can go through the numbers and see precisely where the numbers are coming from. So you can see here, there's the same chart. You go along this column, it actually outlines where the sources of income are coming from, whether it's government benefits or registered money, whether it's tax-free income from sources, could be interest income, dividends, capital gains from the portfolio, and it goes through it year by year in a tabular format and a column, and then at the end you'll total it up and then calculate for the total income that came in that year, the total family income. It does a tax calculation, and then it nets out, calculates the after-tax income. So it's a really powerful spreadsheet that tells you every single year where you're tracking in terms of income. The other spreadsheet that's very helpful for many people is they go, okay, Sean, I can see that I'm fully funded my income, but what's happening to my net worth statement? How much is actually left by the time I get to age 90? So again, that's what this chart's showing. So the green is real estate, and these various shades of lighter blue would be registered accounts. This gray is a tax-free savings account, and the blue here is the non-registered capital. But you can see here there's still significant financial assets left on the balance sheet at age 90. Now where this is helpful is this client knows that there's quite a high probability that they're going to fully fund their long-term income objectives as a couple, and they do know that there's a reasonable probability that they're going to have redundant capital that they could use for legacy planning. So then all of a sudden there's a whole door that opens up to us in terms of planning that wasn't clear before we did this forecast. It becomes much clearer once the forecast is complete. And then the last schedule I'll show you, again, very powerful schedule, is the tax forecast or projected income forecast schedule. So if you look at this, what it'll do is it'll basically show the income plotted against the major tax brackets. So you can see here the first blue line is the lowest rate of tax. We've got the middle tax bracket, and then we've got the upper tax bracket. So you can see while Sam was working, he was pushing money into the top bracket. But once he was fully retired, virtually all of his income was taxed at the lowest tax bracket. So again, we can see that we're exploiting that marginal tax rate very effectively in their situation. So if we look at the other situation, which is Sally, and we look at her tax schedule, again, most of the income is taxed at the lowest tax bracket, but there's some minor inefficiencies. Now again, the only reason we may be, the way we can get that income pushed down the lowest rate is probably adjust their lifestyle figures. So if they said to me, Sean, I don't like the fact that there's some income being pushed into the middle tax bracket, there are some tax strategies we might be able to initiate, but we might also say to them, listen, you're spending $85,000 a year. If we dropped it by $5,000 after tax each year, that will push all your income to the lowest tax bracket. Again, you don't save your money just to, save taxes. I mean, it's there for lifestyle. So if you have to pay a little more incremental tax on some of the income, that may not be, the worst thing that could happen. So that's the financial planning software that we use for our clients. Very powerful. It actually allows you to simulate from a number standpoint what retirement could look like, and it gives very powerful direction to the specific strategies and decisions you need to make as you phase into retirement and then eventually become retired. Anyway, I hope you found this particular video helpful. Again, if you're beginning to think about retirement, don't hesitate to reach out to us. On the blog post, there's a link to my website, seanhumphreys.com, where we can unpack our retirement coaching services in more detail. Anyway, all the best with your planning. You take care. Bye-bye.